Well, it is another one of those Thursdays. South Africa's Monetary Policy Committee will be holding its first meeting of the year to decide on interest rates. Later this afternoon, economists agree that the central bank will continue to hike rates, but they're split on the size of that increase. Last year, of course, was characterized by runaway inflation. It prompted the Reserve Banks of major economies in the world to raise interest rates in an aggressive bid to fight inflation. Well, now we welcome SABC News markets presenter Nastassia Arendse on the agenda to talk to us about what we can expect at the MPC meeting this afternoon. Good morning to you, Nastassia.
Good morning.
So I think what we can all agree on is that it is very difficult economic times, right? Talk to me about really what the Reserve Bank is grappling with just from that tumultuous economy that we're seeing at the moment.
Cool. So basically, starting from the November meeting, the Reserve Bank was dealing with some of the global factors that we saw play out. It was the Russia-Ukraine tensions, which were fueling inflation because it raised the prices of food, energy, and some commodities. As well as at the time we were dealing with China. China was doing their COVID zero policy, and we were all worried about where the global economy was going. So taking into that and the inflation that was quite high, it was all about how do we then bring down inflation, and then locally we were dealing with the possibility of load shedding, increasing and slow growth. So coming into this MPC decision, this is what the Reserve Bank and the MPC colleagues are grappling with. How do you balance low growth and some of the risk factors with bringing down inflation?
And then it doesn't help that we've got all this talk around load shedding, the country obviously very, very frustrated. What are economists then modeling about what the impact of load shedding is going to be to our GDP?
So we've got fourth quarter GDP numbers coming out on March the 7th. So they haven't taken into account really the increase that we've seen stage 6 and the consistency of stage 6. But what was quite notable is that going into the World Economic Forum, National Treasury held its briefing where they downgraded South Africa's GDP forecast, their own forecast, saying that they're looking at it going to 1.6%, which was lower than what the World Bank was even predicting. And when you look at what the IMF is saying about South Africa's GDP, the concern is, of course, electricity. And economists at this point are predicting a V-shaped recovery. So basically what we're looking at is 1.8% at the end of last year, which is 2022, which we'll see in the fourth quarter, and then going into 1.2% this year, and then with a mild recovery of 1.8%. However, there are those who are far more pessimistic, and that is because of electricity issues, and they are, looking at 0.2% and perhaps even a mild recovery of 1.2% only next year.
Sure, that's quite concerning. I'd like to lean towards the optimists, but we also have to be realistic and see what the numbers say. I want to go back to what the MPC is going to be doing with interest rates and what the Reserve Bank is grappling with at the moment. We saw, and I know we've talked about this for a while now, in 2020 and 2021, certainly a lot of reprieve from the Reserve Bank where interest rates are concerned. Those numbers coming back up again. We saw the basis points shoot up in 2022. Just talk to me a little bit about what the Reserve Bank has been doing compares with what reserve banks across the globe are doing.
So the one thing that they all have in common, whether it's South Africa, the Fed, or the ECB, in fact even the UK, is the dichotomy of having to do too much versus doing too little. If you do too little and you don't deal with inflation, you don't want it re-accelerating again, which is what the Fed was grappling with in the 1970s, where they cut their interest rates, and then all of a sudden they had to deal with reigniting inflation. But the other problem is that if you push too high with your interest rate hikes, you risk tilting your economy into a recession. So it's kind of like a tough one. Do you deal with economic growth, recession that will lead to job cuts, or do you deal with inflation? But then the other issue that South Africa we're dealing with is high inflation expectations. And we saw that survey come out late last year where inflation expectations are quite high, which is what the Reserve Bank is trying to grapple with. So with your inflation expectation high, that means that your businesses are trying to plan around it, and by planning around it, you're going to have to increase prices. Then your trade unions are now also planning around it, because if you're expecting inflation to go high, wage negotiations need to go higher as well, especially in terms of what you want your members to take home. That's also the other issue that the US Fed is dealing with, having to deal with the employment numbers that are still quite low, and you're also dealing with wages that are quite high because employers are trying to keep employees employed, and you do that by increasing their wages. So the Fed is trying to deal with inflation, but also preventing it from being stickier, which is slower to deal with, and which is quite similar to what our Reserve Bank is trying to deal with. Getting ahead of inflation expectations and not stopping too soon just in case we have a problem in bringing it down. But what is quite on the positive side is that most are betting on the fact that the Fed will cut rates towards the beginning of the second half, which is what most the consensus is around the markets as well. But now the Fed is trying to kind of cool expectations because there's this pull between what markets are expecting and what the Fed is expecting.
Right.
So the Fed wants to keep rates higher for longer to deal with inflation. Markets are saying, no, you're going to push the economy into recession, so we're betting that you're going to cut rates in the beginning of the second half. That is where the issue is right now.
Yeah.
But inflation expectations, at least from the economists in South Africa, they are expecting inflation to moderate a little bit lower, back at least towards that 3 to 6%, probably 4.5%. But the other issue that had come forward was that everyone was saying that the Reserve Bank was underestimating the inflation given the revisions they've had to do last year. So where inflation sits, we'll see in their MPC decision this afternoon in terms of what their expectations are for inflation and growth.
Yeah, I can tell you this, it's good to hear some optimism. Just hearing the words that inflation may moderate this year gives us something to look forward to, because we've been under so much pressure. And you talk about the balancing act that the Reserve Bank has to do, right? I wonder just what that looks like when you talk about whether or not the Reserve Bank doing too little outweighs what it does, in terms of outweighs what the risk of it doing too much to rein in inflation.
I think right now inflation is the main issue. Deal with inflation, and then we can deal with the economic aspects of it. And that's what has been the major consensus about amongst economists, that let's get inflation back to where it can be, so it benefits consumers in the long run and those who obviously have a salary to take home with, and then we can deal with the economy aspects of it. And that's what the Fed is also trying to do as well. So they basically on the same page, although the issues may be slightly different.
Okay, just this is what we all want to know. What do we start budgeting ourselves for? What are you expecting, or what are economists saying about what we're going to be hearing this afternoon? But also just for the remainder of 2023. I mean, are we expecting more hikes, interest rate hikes, particularly in 2023?
So one economist I spoke to said they are expecting perhaps even 25 basis points this afternoon, but the majority are all saying 50 basis points this afternoon, and that this could be probably the last interest rate hike we see, possibly, we don't know yet, but it's a little bit too early to tell, considering that if you look at the forward rate agreements, it doesn't necessarily project another interest rate hike. So they can't necessarily tell on that particular front, and it might be the case that we hold interest rates and then possibly start seeing them come down towards the latter part of the year. But when you look at with the US, as I mentioned, with the US, it's possibly another 50 basis point hike at their next meeting, which is next week, or even 25 basis points. There's also that split, considering that the Fed had 3 75 basis point hikes last year, with one being 50 in December. So everyone is expecting some kind of hold, a hike and a hold, and then eventually start to see it perhaps drop down a little bit towards the end of the year. But at this point, everything is data dependent, as the Reserve Bank always says.
But so there is a possibility that the interest rates could see a decrease at the end of the year. That's the thing, because and we need to talk about when last we actually saw that pre-COVID-19.
Yes, and again, the dynamics have changed so much since pre-COVID up until now, especially when you look at what's going on globally with a lot of the economies, bracing for some kind of recession, not necessarily a deep recession, but a shallow recession. And the concern coming out of the IMF, for instance, is that a third of the countries globally are going to go into some type of recession, and that could have an impact, especially on countries that have a lot of debt. So the issue right now is, let's see where the data goes, especially with CPI coming in at 7.2%. We still need it back to our target range, and the Fed on the other side still needs it back to come down to about 2%. They're looking at perhaps 3.2% if they continue at their interest rate trajectory.
Yeah. Nastassia, really great having you with us. Thank you so much. And I think just to wrap it up before I let you go, a message to the viewer, the consumer who's listening, and this afternoon we'll be figuring out whether or not they're going to be paying more for their bond or for their car. Is the overall message the messaging that in 2023 continue to tighten the belt?
My overall message is, in 2023, brace yourselves. That's all we can say, because we don't know where the economy is going to go, both locally and globally.